Time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Lawrence Steinberg. He's president at Lawrence Steinberg Wealth Management to talk about something that is very much on the minds of investors. That's gold. And the perpetual question for investors is, how do I invest? Do I buy exposure to the metal, or do I buy shares of companies that mine the metal?
Well, you certainly would have done much better getting exposure to the metal by buying the metal versus buying gold miners. And I use the example of the two largest gold miners in the world, which are Newmont Corp and Barrick Gold, Paul. And despite gold being at an all-time high, both of these stocks are basically lower than they were 30 years ago. The reality is, it seems every time these companies make money, the CEO and management, have stock options, so they're aggressively buying back shares when the price is at an all-time high, and then they often have to either issue equity or retrench when the price of gold is down and the shares are down. As the reality is, these companies have never mind create value for shareholders. The share prices have declined over such a long period of time. It just shows you the futile endeavor of trying to buy gold companies and make money.
And this comes despite the fact that chief executives and boards of directors in this space have been saying for some time now, we're different. We're not pursuing growth at any cost. We're only going to pursue growth that is shareholder friendly.
Correct. And two other things have happened as well. Because of environmental costs, the price of producing an ounce of gold has roughly tripled in the last 25 years to maybe $1,000 an ounce. So that's one issue. The second issue, which we're reading about all over the place, is that all the easy gold in North America has been found. So all of the exploration is taking place in third world countries. There have been all kinds of environmental issues and other ugly situations that have happened that have cost these companies tons of money, and doing business in a lot of those places is not as simple as doing business in a Western country, which has also hurt all of them.
What do you think of acquisitions in this space? Another, in my opinion, a troublesome history. The two companies that you mentioned, Barrick and Newmont, have made innumerable acquisitions over the past 20 or 25 years. And as you correctly point out, the acquisitions appear to have done nothing for shareholders.
They've destroyed shareholder value. And again, I've brought this up in the past with several executives of companies like this, which is the only time they make acquisitions is when the price of gold is at an all-time high and they have a lot of cash flow. Because they never want to sit with cash. So they spend their cash, then they buy assets when the price is high, and then they end up writing it down, when in fact, a rational investor with a long-term focus would be building cash during the good times to be able to spend it and buy things at depressed prices.
So it seems pretty clear you do not favor buying gold stocks. What about the metal? Is there more?
I've never owned a gold stock in my life. I do not own gold. It's so much easier, as Warren Buffett would point out, to buy companies whose earnings are growing over time and who also are not dependent on the price of a commodity like gold.
Does that mean you do avoid other commodity-related stocks as well?
We do have some commodity stocks, but it's a small part of our portfolio, and it would be very, company-specific.
One of the earnings stories we're tracking today is GM. Shares are up more than 4% after the automaker reported its latest quarterly results, which got a thumbs up on Wall Street. The outlook was encouraging, according to analysts. Truck sales in North America helping to offset some flat performance in the rest of the world, and selling prices remaining near record highs. Now, remember, for GM, the company had dialed back its EV hopes, even though not that long ago they were betting very big on a new fleet of vehicles tied to the EV transition. But here we are with GM retooling, the stock benefiting at a time when its EV rival Tesla seems to be on the ropes. Let's get some more perspective now from Garrett Nelson. He's a senior equity analyst at CFRA Research. Garrett, great to have you back with us. What is your assessment of the GM story right now?
Yeah, thanks for having me. No question, this was a positive earnings release. They beat on the bottom line by a wide margin. And they raised their full-year earnings guidance. If you dig a little bit deeper, though, into the release, you'll see that of the 19% year-over-year earnings growth that they posted, 17% of that was due to a lower share count due to the accelerated share repurchases that they executed in Q4. So So actually, their organic earnings growth was pretty sluggish, only about 2% year over year. So global sales volume was down 2.5%, and this is a stock that has rallied massively over the last 5 months or so since the UAW strike was settled in November. The stock price is up more than 50% over that time. So we have a note out this morning. We've maintained a hold rating on the stock, and we're concerned about them not being able to make share repurchases in the future. They have a massive amount of capex, and also this decision to really go all in on pure battery EVs, we think is going to cost them because they've really shunned hybrid vehicles. They made a decision 4 or 5 years ago to go all in on battery EVs, and as a result, they don't really have any hybrid vehicles, available in the market right now. And that's where consumers are showing a lot more interest. In fact, the hybrid market is now growing faster than the EV market. So we see some red flags looking ahead for GM.
I do want to talk about the long-term landscape, especially with EVs, but can you just clarify to our audience why the hybrid market is gaining some momentum right now, and is there a dominant player in the hybrid world in the auto sector right now?
Yeah, so it's mainly a lot of the Asian automakers, Toyota, Honda, Hyundai, Kia, really made a decision to not invest much in pure battery EVs and to go the hybrid route. And as a result, those are some of the best-selling hybrid manufacturers in the North American market. And so, the hybrid market is growing a lot faster. And what we think is happening is that the early adopters of EVs, have already purchased a Tesla or another EV, and so automakers are having to sell EVs to the mass market now, which is proving to be a much tougher sell. And so, but consumers are showing a lot more interest in hybrids. They're much less expensive, and you can take them on long distance trips, which is without having to stop for 30 or 45 minutes to recharge. So, consumers are showing a lot more interest in hybrids, and we're more bullish on the growth outlook over the next few years for the hybrid market relative to battery EVs.
Well, you raise a good point, that issue of where you stop for charging, which has been a big topic of conversation over the last year as Tesla with that supercharger network has been striking all sorts of partnerships with other automakers. But I bring up Tesla because it feels like in the eyes of investors, things could not be worse right now. It's been a really rough year in terms of a reassessment. They'll have quarterly results later. Here's my question for you, Garrett, because I used to cover Silicon Valley very closely. You have earnings reports, you have periods where there's an up and a down as measured through a stock price. But over the next decade, what is going to happen? Even if the consumer demand for now has tapped out in EVs, do you see us transitioning more so over the next decade to that world? And how are these companies prepared for the future? Do you think that Tesla has a lot of work ahead, or does that lead actually mean that they're going to be in a better position, say 5 or 10 years from now?
All great questions. And, no question the stakes are extremely high for Tesla heading into this earnings release. They've missed on the bottom line each of the last 2 quarters. The stock price is down more than 40% after the stock price more than doubled last year. So it's had a tremendous pullback. And so there's a lot on the line heading into this earnings release. But one thing we've seen other automakers really pulling back on their EV investments and EV growth plans in favor of developing more hybrids. And we think that opens a lane up for Tesla. And we see them having less competition years down the road in the EV market. It's not that the EV market is contracting. It's still growing, both domestically and globally. but just at a much slower rate than was expected a few years ago. So, we're positive on Tesla here. Following the sell-off in the stock, we'll see what they have to say. But they're in a lot different position than they were a few years ago. This is a company with an investment-grade balance sheet. They have over $29 billion of cash, industry-leading margins, and still generating positive free cash flow, even after a steady round of price cuts on their vehicles over the last year or so. So, and also, this is a company that, in our opinion, is full of people with some of the brightest minds on the planet. And so we're confident that they're going to, navigate their way, past this lull in demand that we're seeing, and that they're going to emerge stronger coming out of this.
All right, I do have a final question. We could probably talk for 20 minutes about it, but I'll ask you. Hopefully, we can keep it brief. The other thing with Tesla is, it seems like, based on all the reporting, and Bloomberg's done some reporting, that if Elon Musk had his way, he would just push ahead into this autonomous vehicle, this robo-taxi dream he's had, a future where he sees just fewer people driving at all, and certainly driving more electric vehicles. And maybe you think of a Tesla the way you think of an Uber going forward. What are your thoughts on that? Because it seems like he's going to be trying to push the narrative towards that, especially if EV sales slump through the rest of this year.
Yeah, the fully autonomous level 5 vehicle is coming. It's just a question of when, how long it takes. Elon Musk famously has been promising that for years. They're still, not anywhere near hitting full autonomy. But what we've seen is, with each software update, they get closer and closer to full autonomy. And so, in our opinion, they're leading the race in terms of autonomous driving. It's a tremendous market opportunity for the company, which would really give Tesla a massive competitive advantage relative to other automakers. And those other automakers are really pulling back on their autonomous related investments. So, that's another thing, investors are going to be looking for, is what they have to say at this investor day that they're planning to host in August along those lines. And, from our opinion, that they are leading the race, and they will probably win the race. And it's just a matter of when they get there, not if.
All right, well, we are seeing a little bit of weakness for Canadian stocks today, but increasingly we've seen some interest in some of the commodity-related names that trade in Toronto. And if you do see some sticky inflation, that could actually benefit some of those commodity players over the longer term. Earlier, we spoke with David Burrows, his Chief Investment Officer at Barometer Capital Management, for his take on Canadian market performance.
Of course, markets pulled back because we had a sharp run-up in yields, right, and a sharp run-up in the U.S. dollar versus the basket of world currencies. And that's a concern, because for those people that worry that rates are going to choke off the economy, that's something to think about. But we know we kind of have a split world. We've got a fair bit of debt with the consumer, and that is having an impact on consumer-related companies. But on the other hand, companies in the financial services industry and companies in the industrial companies are performing really well, because in many cases the big industrial companies termed out their debt, moved their debt to very long-term debt at low rates. So rates really aren't affecting them. They're generating a lot of cash. Financial services companies benefit from a rising rate environment, and we're seeing that in the banks. So for the people that are concerned we're really going to have a slowdown, it would be a non sequitur that the financial services industry is hitting new relative highs versus the market. And also the industrials are hitting new relative highs versus the market. Those canaries in the coal mine should be should be weak if you thought things were slowing down. So I think that in general, these parts of the economy and the market are very, very attractive.
Does that mean, and I know the Canadian economy has its own specifics, so this is more of a U.S. economy question, but does it mean that we should now be having a bigger, broader conversation that is about what happens to the market if the economy is chugging along, as opposed to reassessing when the U.S. Federal Reserve cuts interest rates and the bond market reacting to that?
Yeah, I think so. If you look at where the biggest exposures are in the market where people have piled in. They piled into long-term growth stocks, which are very well owned and not inexpensive, and they've been relatively weaker performers over the last 4 months. And the things that are more defensive got piled into, and they've been really poorly performing, things like consumer staples and telecom and so on. On the other hand, the things that benefit if inflation's a little stickier and the economy's a little stronger, they're underowned in general, but they're outperforming by quite a lot. And it's a bigger thing outside of the US because industrials and financials make a much bigger part of the global markets.
So you're the second guest this morning who've talked about that phenomenon of stocks that are outperforming that are actually underowned. It came up earlier in the context of energy names, which we're going to talk about later in the program as well today. But just as an example, because you always bring stock ideas to the table, Question Point, we get a lot of viewer questions about it. What are the dynamics surrounding a business like that would sort of speak to you as a good opportunity?
Well, certainly if you look at oil inventories, they're relatively low. If you look at ownership of the energy sector, it's relatively low. Remember that the energy sector has been as much as 15% of the S&P in the past. Right now it's about 4%, up from about 2% 2 years ago. But in a company like Crescent Point, like many other energy companies, they got rid of some non-core assets. They focused really in the Duvernay and the Montney. They have a very long inventory of drilling targets that they can work on. Some of their newest drill results are among the best results that have come out of the Montney recently. But like other energy companies, they've been paying down their debt, and they plan to continue to. They're returning free cash flow to their investors. And so we think that if you think inflation may be a little stickier, and we do, then you probably want to have some energy exposure because you want to own something that hedges you against rising inflation.
Let's talk about another stock that kind of gets caught up in the inflation story. I get quite confused on what the market's view is on the moving parts that move gold right now. This is sort of like a whole laundry list.
Right.
But Agnico Eagle is a stock that you've talked about with us in the past. It is definitely a company that is aligned with what's happening in the gold world. How do you think about that one?
Look, there is just an absolute ton of sovereign debt out there. If you look at the issuance that the U.S. is going to have to make over the next 2 years, it's off the charts. And this is having a big impact. So we think that, in effect, the purchasing power of dollars is really being eroded. And one way you can protect against that is in the golds. Now, commodities in general went through a 10-year bear market. They have certainly wakened up over the last couple of years, and gold, technically broke out. So if you want to invest in that, you can own gold itself, or you can own a producer that's a solid producer that has a lot of diversity. They have 11 mines in safe jurisdictions, safe geographic regions. They have a relatively low cost to produce, around $900 an ounce. They'll produce about 3.5 million ounces, which is great. But if the price of gold goes up, you get some value for all that gold they've got in the ground, and you get some leverage on that. So Agnico Eagle is the institutional investors' go-to company. It's the third biggest producer in the world. They generate a lot of cash, and it's an inexpensive stock, and it's a way that you can participate in this area without having to move down into more speculative companies.
Okay, and then another name that you are ready to talk about today is Finning, which sells a lot of cat gear.
Yep.
They actually operate around the world. They're not just operating here in Canada. But I guess sort of with that industrials theme, what do the prospects look like, in your opinion, for a company like that?
Well, so they're the biggest cat dealer in the world. They're in Canada and South America and the UK, and they really sell into three markets. I've just said that I think that we've started a new long-term bull market for commodities, and of course they sell to the commodity producers for building new mines and so on. Second, we're spending a lot of money on infrastructure, and they play into the infrastructure industry, and that's a lot of fiscal stimulus happening in those areas. And then third, we know that the power grid and power production is going to have to grow, especially for things like AI and cloud-based computing and all of the new manufacturing that's coming to the U.S., and they play into the utility sector. So they play into three growth sectors that have a secular tailwind. So, you're basically selling picks and shovels, to the industries that are investing a lot.
And then finally, we've been talking about the rails this morning, out with quarterly results. CP Kansas City among the companies on an adjusted basis. Looks like they missed estimates, but there's a short-term story and there's a longer-term story. And if memory serves, bringing those two railroads together for you to have kind of a, call it a North American powerhouse, was a pretty attractive business idea for the next decade. Is that fair to say?
Right. So think of it in simple terms. We're seeing a reacceleration in manufacturing. So after 16 months of negative manufacturing numbers, last month the manufacturing data was positive. So we're looking at the next business cycle. This is a company that not only benefits from an improvement there, and this is going to take time over a series of quarters, but they also have significant cost savings that they're going to bake into that merger between Kansas City and CP. Remember, they ship to 3 coasts, east, west, and into the Gulf. And so they got a lot of coverage across a lot of industries. And I think this is a very good way to participate in the U.S. industrial economy.
Investors were jarred today by signs of persistent inflation in the United States. There are further dampening of expectations for rate cuts anytime soon. So how should you position your portfolio should this volatility worsen? We're joined by Ross Mayfield, investment strategy analyst at Baird. Ross, thanks very much for coming on the show.
Thanks for having me.
Give us your thoughts just on inflation right now. I know we've heard about it ad nauseum, but should it be an important factor in people's investment decisions?
Yeah, absolutely. I mean, we're clearly in kind of a new regime, I think, here post-pandemic versus particularly the decade prior to the pandemic, where inflation was not a problem at all and interest rates were suppressed and hyper low. Even if inflation proves sticky in that 3.5% range, and maybe the long end of the Treasury curve is in the 4 to 5% range, that represents a drastically different playbook from the one that might have worked in the prior decade. And I think it requires a change of attitude for investors as well. So I do think inflation should be top of mind. We have PCE tomorrow, which is obviously huge for the Fed. But I think you can count on a higher for longer rate regime, even if the Fed gets a cut in here or there.
So we get that personal consumption expenditure inflation, tomorrow, that's so important to the Fed. What about utilities? When you look at utility stocks, obviously they are vulnerable if rates stay high, in that people buy them for the yield. What pattern are you seeing in utility stocks?
Look, they're working here. They've started to kind of carve out a bottom and show signs of life for the first time in a while, which, if you're taking the message from the market, it is a little bit concerning, right? Defensive, as you mentioned, yield proxies popping at a time when rates are also rising. So what does that say? It means investors are a little bit worried or more worried about the growth outlook for the economy. It's not a place that I'm particularly excited about because I do think there are still so many other places to get growth out there. And if you want, a defensive hedge or a yield proxy, you can look to the fixed income market because you are getting solid yield in treasuries. And even if you went out the credit spectrum a little bit, you can get really, really nice yields on some high quality corporates. So I would typically think, you might barbell more cyclical and growth oriented exposure in the stock market with something a little more defensive in fixed income, as opposed to chasing utilities, which I just, there's not a lot of upside growth there. And as you mentioned, the dividend is kind of neutered by the fact that rates are giving you what they are.
You think that investors have been a bit hard on consumer discretionary stocks?
I do. I think there's a narrative that the consumer is tapped out. And in reality, we've heard that narrative for much of the past couple of years. Oh, once stimulus wears off, the consumer will fall off a cliff. Oh, when student loans resume, the consumer will fall off a cliff. We haven't hit that cliff yet. And to be honest, if you look at the GDP report today, the consumption piece was not the problem. There was a bit of a drag from import exports, but the retail sales, the last print was strong. The job market is obviously still very tight, and consumption has been solid. So I think there's still legs to the consumer story, particularly given the tight labor market. And so I do think that discretionary shares have been beat up a bit, and I think there's probably some real value out there now.
And as a broad, okay, so we're looking at some of your maybe we can put up that board again because it came and went very quickly, thanks. Industrial stocks too, you think that there's value there?
Yeah, absolutely. Industrials have been a favorite for over a year now, just beating the drum on them because I think they're underloved. They kind of get put in that value bucket, so they're not as exciting as growth. And especially last year when AI was all the rage. But there's cyclical tailwinds, right? Economic growth is a tailwind for cyclical sectors, economically sensitive sectors like industrials. You have structural tailwinds in the form of infrastructure spend, in the form of big fiscal investment into building out green energy and infrastructure, as well as an increasing allocation both in the US and abroad to the aerospace and defense sector as the world kind of fractures a little bit here. So there's a lot of, I think, near-term tailwinds, but also structural tailwinds that make me like the sector a lot. It's a very diverse sector, so active management really has a chance to outperform in that arena, but we continue to like it.
It's time now for On the Radar, when we asked an investing professional what they're looking at in today's markets. We're going to talk about gold earnings with our featured guest, John Ing at Maison Placement Canada. We're going to talk about the results at Agnico Eagle Mines and Newmont Mining, two of the big players. Newmont is the world's largest producer. At Agnico Eagle, payable gold production was just under 879,000 ounces of gold at an all-in sustaining cost of $1,190 US dollars per ounce. Adjusted net income or profit came in at just under $378 million or 76 cents per share, and the company has repeated its 2024 gold production and capital spending guidance. John, what do you see in the results at Agnico?
The results were in line with expectations. In the fourth quarter, they produced something like 900,000 ounces, and they're pretty close. Significantly, it's everything seems to be operating well, and that's great in the mining business. At Detour Lake, they bumped up output to about 71,000 tons. That's good for that mine. That's one of their tier one mines. At Canadian Malartic, their other big mine, my expectation is that they are well along in bringing Odyssey into production. And that's the key about Agnico Eagle, execution, and they're very good at that.
And at Newmont, the company has reported 2.2 million ounces of gold equivalent. That breaks down to about 1.7 million ounces of gold and about 500,000 ounces of gold equivalent ounces, which is coming from gold, copper, silver, lead, and zinc. So other minerals that the company converts on a financial basis to gold, all in sustaining costs. So we're going to talk about that number later in this program with John, what exactly it means and why it's important to investors, of just over $1,400 US dollars per ounce. Adjusted net income comes in at 55 cents per share, and the company likewise says it's firmly on track to meet its 2024 guidance on production costs and capital spending. What do you see in the Newmont results?
Well, Paul, every mining company leads off to say it was terrific results. But when you look a little closer, what you saw with Newmont is that their production in the first quarter was down 4%. And plus, as we know, they have some mines that they're going to be selling, and they took another $500 million write-down on the mines that they proposed to sell. The problems at Newmont, again, Tanami was disappointing, Boddington was disappointing, but it's a legacy of some of the assets that they bought. They pointed to Newcrest, although I didn't see much details about Newcrest. The reality, I think, is that Newmont has to absorb, has to make these acquisitions work. And frankly, it's costing them a lot of money. It's costing them in destruction of market value, that's for sure. But also management time. They changed their COO in the end of the quarter. My expectation is that they've got a tough road to hoe.
Of the major gold producer stocks, which do you favor right now?
Well, I think Barrick is the go-to stock. It has been for some time. They've got a great balance sheet now. They've got some big projects coming down, Reko Diq in Pakistan. Now, there are some that say, from a geographic point of view, it's risky. Well, nowadays, all the low-hanging fruit have been plucked, and Canada was once a big producer. Canada is no longer a big producer. You have to go out and look for these big projects. And the government is partners on these deals. So my expectation is when you look at Barrick, they have ounces coming down the pipe, and that's there's a shortage of reserves in the ground. And so my expectation is you got to look for growth. It's going to come from Barrick.